So you have to make, almost day-by-day decisions on where to put your money and your investments. Given this possible manufacturing recession that we're seeing worldwide, and now we talk about potential growth, which is the growth at pace an economy can grow without inflation heating up, does it change your view on where you want your money to be?
Yes, it does. So basically what we try to do is create a barbell, basically investing in financials at the credit space, whereby as long as we have 0 to 1% growth globally, we're hanging in and we're clipping a 5 to 6% coupon, while at the same time buying protection on even shorting high-yield company, extremely leveraged, where today the price of those bonds are super high simply because of quantitative easing and negative interest rates.
Okay, is there something that the market is actually getting wrong?
I think the market is, what is getting wrong is the fact that some of the extremely risky bonds are priced for perfection simply because investors have no place to hide, and so they've been buying too much risk. And so what we're doing is we're actually looking at them and actively buying protection of them. And they can be weak company, over-levered company, triple C company. You have lots of, in my view, speculative investments that have been just, bought up by the market simply because of the search for yield.
But is this, is it bubbles, and is it bubbles that could burst?
I think there are bubbles that can burst, because if you look at the index and some of the high-yield companies in Europe, for example, what they yield, it makes no sense. And I think eventually the refinancing cycle, the next 2-3 years of some of these bonds will be very painful. So I think what we're doing is we're investing in safe and boring, typically global financial, systemically important institution in the credit space, where we're getting paid 5 to 6% in dollars, which in today's world is very attractive. And at the same time, we're buying protection on some of the high-yield companies that yield in 2 to 3, but in our view, won't get refinanced. And if there is a recession in manufacturing, they'll be badly hit.
Davide, when you look at the two economic slowdown data of the last 24 hours, and that would be the U.S. data and now the German forecast out coming in at a soggy 1.1%, what does it mean for the financial system? You're truly expertise there. Does it mean that we rush to scale in the European banks?
What I think for European banks is eventually there is oversupply in terms of too many banks, too many employees, too many branches, and capacity will have to come out of the market. Given that now the top 120 institutions are properly and adequately capitalized, I would imagine M&A to start domestically first. So not cross-border, because there is not such a thing as a single market yet in banking, but you'll probably see more domestic consolidation. And I think this will accelerate post-Brexit. Because Brexit is another jolt to European growth, and as a result will lead to further consolidation domestically, first in Europe. And in the UK, I would imagine some of the smaller institutions will have a very, very tough time. So I wouldn't sleep at night if I was an incumbent or a challenger bank in the UK, that's for sure.